Yes, if you're watching this video right now, I want to say a very big congratulations to you because you have taken a bold step towards fighting poverty, right? Yeah, I'm saying a big congratulations to you because you have taken a bold step towards changing your financial situation. And you know what the good thing is? You choose Forex. And this is me saying if you remain consistent in the game, you show up every day, you are definitely going to win. Now, Forex has the capacity to change your life for good financially, right? So, this is me saying big congratulations to you once again. With that being said, I just want us to dive in straight with what we have for you in today's course. Right, right on our screen here, what we can see is foundations. In this course, I'm gonna be taking you through how I'm gonna be taking you through what you need to know about Forex. Uh Pretty much the basic knowledge, the basic things you need to know about Forex. That is the reason why you see on your screen foundations of Forex. Okay. As you all know, my name is Vince and I'm gonna be your host for today's course. Yes. With that being said, let's just dive in straight with what we have for you guys in today's course. All right. So this is it. Forex. Now you might be asking yourself, what is Forex? What is Forex? I want to say to you today that the simple meaning of Forex is just foreign exchange. No two ways about it. The full meaning of Forex is foreign exchange. Now, the FOR there means foreign, and the EX means exchange. And it is a global market where the world currencies exchange and at a mutual agreed rate. In other words, it is uh, the buying and selling of cryptocurrencies at a mutual agreed rate. Now, this exchange rates constantly change every seconds. So the market is constantly fluctuating. Now, what does this mean? You might let's take for instance, you're a Nigerian. Over the past few months, you're going to see that the price of the naira against the dollar is, really fluctuating. As of last 2 months, the price of a dollar to a naira is 1,700 naira, and currently, as I'm speaking to you, it is around 1,600 naira. So the forex market is constantly fluctuating. It is not constant, right? So moving on, let's go. Now, the forex market is the largest financial market with a trading volume of, a daily trading volume of $7 trillion. Wow, this is massive. Now, now the money that flows into the forex market daily is over $7 trillion. Wow, guys, this is trillion. 7 trillion, not a billion, not a million, 7 trillion. Now, this is way, 100 times bigger than the New York stock market. Guys, this is really massive, guys. Now, the forex market controls, money flows into the forex market daily, like massive, right? So let's go on. Now, like I said earlier, it is forex markets. Forex trading is, just the conversion of one currency to another. That is basically what it means. It is just the conversion of one currency to another, right? Now, let's take for instance, you are converting the Great British Pound to the US dollar, right? Now, let's just take for instance, you traveling to, you're a Nigerian and you travel to Ghana, right? Now, you when you travel to Ghana, you don't use the currency, the Nigerian currency which you have. Now you have to visit an exchange store to convert your naira currency into your Ghana cedis, so you'll be able to, buy and sell. Buy things. Use money in Ghana, right? So that's just what I'm just trying to explain. I hope that makes sense to you, right? Okay, let's move on. Now the forex market is open for 24 hours in a day and also 5 days in a week. That's the forex market is open for from Monday till Friday. So if you are dreaming to be a forex trader, you have got to choose your days to your working days from Monday to Friday. Like I said to you, I forgot to mention this to you. If you are a traveler, right? Let's say you might have traveled from Nigerian to maybe Ghana, to maybe London, to maybe Spain. You have indirectly participated in the forex market even without you knowing, right? Let's move on. Now, the forex market are always quoted in pairs, right? Now, if you look straight here, this is a pair, like this is it, Euro USD. It is always quoted in pairs. Now, he said the price of a pair is how much of a quote currency it costs to buy 1 unit of a base currency. Now, let's say you want to buy Euro USD, right? Let's see this now. This Euro USD you're seeing here, this is a pair, and the Euro on the right, the Euro on the left is the base currency, and the USD on the right is the quote currency. Does that make sense to you? Right? I guess it does. And what this means here is that let's just take it again. The price of a pair is how much of a quote currency it costs to buy 1 unit of a base currency. Now, it will take you, if you are to buy 1 Euro USD, it will take you 1.50316 US dollars to purchase 1 euro. 1 euro, right? 1.50316 to purchase 1 euro. Does that make sense to you guys? I guess it does, right? Now, moving on, it say when you trade forex, you are always buying one currency while selling the other. Now, guys, let's say you want to buy Euro USD, right here. You are essentially, you are buying Euro while selling USD at the same time, right? You are exchanging Euro. You're exchanging US dollar for the Euro. So let's move on. Now, uh how does forex trading works? How does forex trading works? Now, when you buy Euro USD, you expect the price of the euro to go up. That which is the base currency. The euro is the base currency. When you buy Euro USD, you expect the base currency to go up while the quote currency goes down. That's just the simple. And if when you buy Euro USD, the euro strengthens against the US dollar, you make money, guys. Guess what? You make money. Yeah, that's it. And in the other hand, when you sell Euro USD, you expect the price of the euro, the base currency, to go down while you buy the US dollar. And if the euro weakens against the US dollar, guess what, guys? You make money. That is essentially how the forex market works. So, guys, this is it. Still moving on, still on how does forex trading works. You see, for one currency to go up, there will be another weakening against it. That is essentially how it is. Now, for 1 euro, for a pair, if for one currency to go up, right, there will be another weakening. When you are buying the Euro USD, you're essentially uh exchanging the US dollar for the euro, and in that the US dollar has to weaken against the euro. Now, all currency cannot go up at the same time. Yeah, when you are buying Euro USD, the both currencies won't go up at the same time. One has to go down and the other has to go up, right? Now, there is always going to be a winner and a loser. Now, if you're a forex trader, let's say you place a trade and then you lose that trade, right? Now, there is a winner out there which has won your money from you. And when you win money from the market, yeah, you have uh you essentially have won the money from a loser out there, right? That is essentially how it works. Now, forex trader weigh up whether a currency looks likely to strengthen or weaken against another. Then the trader pair accordingly. Right. Let's just move on. Who trades forex, guys? You might be asking, who are the forex traders? I mean, which people trade forex? Okay, this is me saying one of the big these people here, if one on my list here is the big banks and the large institutions. Guys, these people, I like to call them uh the big boys, right? The big banks here are, let's just give this the World Bank. Let's just give this to the World Bank, right? And the large financial institution here are, the hedge funds, the Soros funds, the Black Rocks. These guys, as they have, I mean, large, I mean, huge amount of money. They are the ones. When you say the market, you might have heard someone saying the market is being manipulated. The market is being manipulated. Now, these people are the ones who manipulate the market, right? I mean, they have the huge capacity. I mean, the huge amount of funds to move. They are the ones who move the market, right? Number two on our list here is uh banks and governments. Now, these banks here might be your local banks, the banks in your country, and these people here, they are able to, they are still able to move the market, right? When they say a news is coming out, these are the people, that brings the news, right? And when a news, you must have noticed, whenever a news comes up, especially if it's an high impact news, the market tends to, moves really, really fast. And the third on our list here is in large commercial companies. Now, these large commercial companies, they pretty much do have employees abroad, right? Now, when they pay their employees, some companies do pay their employees weekly or either monthly. Now, when they are being paid, those employees have to convert those currencies, to their local currencies. Now, when they do that, they've essentially participated in the forex market, and this in turn either causes the market to go up or even go down, right? And the fourth on our list here is what I call the small fishes in the market, which is you and me. Yes, this is where we place ourselves, and we right here, we are just the small fishes in the market. We are following the full step of the big banks, and the large financial institution, the big boys, the people I call the big boys. This now, we don't have the capacity, we don't even have that amount of funds to move the market, right? No. What we do is to trade according to how the big boys are trading. Now, if you trade against these big boys, guess what, guys? You lose money. Let's go on. Now, how do you determine whether a currency pair is going up or going down? Now, let's say you want to take a trade, and you've done your analysis, you've done everything, and you say, uh, okay, I know this market is going to go up. Guys, I want to say to you that as a forex trader, you don't know if the market will go down or go down. Yes, you don't. You don't know if the market. It shouldn't matter. Is the forex market is random, and every trade you take is, without it getting to the without it getting to your take profit, I mean, the trade is random. I mean, forex trading is a probability game, and every trade outcome is random, no matter how confident you are on that trade. That's what I'm trying to explain to you guys. No matter how confident you are on that your trade, I mean, the outcome is still random. It might go 50-50. Now, the trade, you might place a trade and it will just be few pips to your, few pips to your take profit, and an high impact news will just come outside. Guess what, guys? You just lose money. I mean, you just see your trade go against you, and then your stop loss is gonna be hit. That's why I said every trade, outcome is random, no matter how confident you are on that trade. Now, however, you can increase your probability of winning a trade by developing an edge. What do I call an edge? Now, an edge is what separates winning trades from losing trades. As simple as that. Now, as a forex trader, you need to have a mechanism, a systematic way, an algorithm at which you approach the market, right? That is what I call an edge. Now, if you can't just wake up in the morning and just say you want to place a trade. Come on, you're definitely going to lose money, right? You're going to lose money. And what do I call an edge? This is my definition of edge: your trading strategy that helps you make more profits than your losses. That is just what I call an edge. It is your trading strategy that helps you make money that helps you make more profit than your losses. That's just it, guys. Now you need to develop an edge as a forex trader, so you are going to make how money from the market. Like I said, you can't just wake up in the morning and just place a trade, right? You just have to have a systematic way at which you approach the market, right? Moving on. Now, you need to master these three M's to develop your edge. This is how you get to develop your edge. The first M here is method. Method. Now, this method here is more like, let's say, a strategy. Yes, at which you work. Now, this method here might be, you following the footstep of the big banks here. You know when they are buying, you know when they are selling, you know when to place a trade, you know when to enter. That's just it. This is the method, right? Now, the next M here is money management. I like to call this risk management. Now, you don't want to you just need to know how to manage your capital while trading. Now, when you're trading, you don't want to expose your whole capital to the market. Always try to add stop loss your to your trade, right? It's going to help you, right? Now, I mean, to develop your edge, you need to master method at which you approach the market. You need to master money management. And the last M here is your mindset. Now, you need to know how to control your mind when you have an open trade. Now, when some people, when they have an open trade, they tend to start panicking. Oh man, they open their MetaTrader for every second to check if the trade is going their way. The truth of the matter is, guys, since you trust your method at which you approach the market, all you just want to do is to set and forget. If you are the type that check your MetaTrader for always and blah blah blah, like, oh man, this trade is not going my way, guys, you're gonna get your mind messed up with, guys. So as time goes on, you tend to familiarize yourself with these terms. Let's go on. Now, I want to introduce your best friend to you. Now that you are in the forex trading journey, you are going to be familiarizing yourself with these. This is going to be your best friend for now, and they are currency pairs. Now, what is a currency pair? Let's go on. Currency pair are the price of a quote of the exchange rate for two different currency traded in the forex market. Right? Now, this is the basic meaning of forex. Currency pair. It is just the combination of one country currency against the other. That is what we call a pair. Now, all currency pair are identified by their ISO code. I like to call it ISO code. Now, this is what I mean by that. When you see GBP, this is the ISO code. GBP is the ISO code, and the ISO code is the combination of the country code and the currency code. Now, the GB here means Great British, which is the country, and the P here means the pound, which is the currency, Great British Pound. Right? Does that make sense to you? And this here is the JPY. This here, the J here stands for Japanese. The JP here stands for Japanese. Japan, and the Y here stands for yen, Japan yen. So we call this the Japanese yen, right? And the last on our list here is the US dollar, which is the best friend of every forex trader, the US dollar, right? The US here stands for United States, and The DS stands for dollar. So that is what we mean by ISO code, right? So let's go back. I think we've passed it. Now this is it, guys. Currency pair. This is an we have three types of currency pairs, right? We have the major pair, we have the minor pair, we have the exotic pairs. Now this is meant to be exotics, right? There's an error here. Exotics pairs. Now this is it. What are major pair? Major pair are pairs that includes the US dollar. Now these are pairs that has the US dollar in them. The example are the Euro USD, the GBP USD, the NZD USD, the USD CHF, the USD JPY, the USD CAD. These are essentially pairs that has the US dollar in them. And for those who doesn't know how to pronounce them, this is just the Euro United States, the Euro against the United States dollar, the Great British Pounds against the US dollar, the New Zealand dollar against the US dollar, the US dollar against the Swiss franc, the US dollar against the Japanese yen, the US dollar against the Canadian dollar. This is essentially pairs, like I said, that has the US dollar in them. Now, these pairs are pairs that are the most traded. Now, since the US dollar is the most traded in the forex markets, they tend to provide more trading opportunities, right, to traders. So these are pairs that are most traded. They have the most trading volumes in the market, right? So this is it. Now we move on to minor pairs. These are pairs that includes any of two major pairs except two major currencies except the US dollar. Basically, these are pairs that has two major pairs except the US dollar. Examples: GBP JPY, Euro JPY, Euro CHF, AUD CAD, AUD CHF, GBP AUD. Right, guys, so this is it. For those who doesn't know how to pronounce this, I'm just going to pronounce it. You see, this is the Great British Pound against the Japan yen, against the Japanese yen. This is the Euro against the Japanese yen. This is the Euro against the Swiss franc. This is the Australian dollar against the Canadian dollar. This is the Australian dollar against the Swiss franc. This is the Great British Pound against the Australian dollar, right? So this is it, guys. We move on to the exotic pairs. Now, the exotic pairs are pairs that include one major pair, one major currency, and one other pair from emerging markets. Now, you might be asking what are emerging markets. Emerging markets are pairs from either uh pairs from either the African country or the Asian countries, right? These are essentially pairs that are combined with one major currency and emerging markets, like pairs from the Asian countries or from the African countries. Examples are the US dollar against the Nigerian naira. Right, now, this is a major pair, and this is a pair from uh, an African country, Nigerian, the Africans of the African giants. Right, so this is the next on our list here is the US dollar against the I think I've forgotten this pair. Oh my god. Okay, this is the Singapore dollar, right? Okay, yes, I remember now. This is the US dollar against the Singapore dollar. This is the US dollar against the Thailand baht, right? Let's move on. Now, what currency pairs should you be trading? Now, the truth of the matter is, as a beginner, I advise you to, stick with major currencies. Major currency pair. If you want to start trading now, why? Because the major currencies, like I said earlier, they offer more trading opportunity than any other pairs. Now, guys, there's something I want to explain to you about exotic pairs. Now, these guys, see, if as much as possible, guys, we traders, we try to stay away from exotic pairs. See, the thing is, these exotic pairs, they are not being traded, so they are very dangerous. When they are very dangerous in a sense that when news comes out, since they're not being traded, they tend to go crazy, really, really crazy. So as much as possible, we try to stay away from exotic pairs because they are really, really dangerous. So as a trader, you don't want to, find yourself trading. Now, the reason why I'm, just explaining this to you is because I just want to let you know that these pairs exist, right? They exist, and we do not trade them, right? So, like I was saying here, as a beginner, please, I would want you to stick to trading just major currencies, right? Just trade the major currency pair. Example are Euro USD, the GBP USD, the NZD USD, the USD JPY, the USD Canadian dollar, right? These pairs offer more trading opportunities, like really good trading opportunities. And as a beginner, this is what you want to, familiarize yourself with, right? So moving on, as a beginner, please, I'll need you to stick to one, maximum three currency pairs. Stick to one or three trading pairs. You don't want to, when you start trading, you don't want to, start messing yourself. I mean, start, giving your focus to multiple currency pairs. Like, you want to focus on one, maximum three. As a beginner, I just like to, like you to stick to just one currency pair, because you are going to master that one. The truth of the matter is, best for you to, be a master of one currency pair than just to be a jack of, multiple currency pairs. Just be a master of one, and you're gonna find yourself. Now, this picture here is these are currency pairs on my watch list. Right now, the reason why you can see five pairs, I guess one, two, three, four, five pairs here, is because you um I'm a little bit more advanced than you may think. Yes, that's why. And the truth of the matter is, I'm not even focusing on. I know what I'm doing. I'm not even focusing on all these currency pairs. Right now, if you look straight here, if you look on GBP USD, there is a red flag at the beginning. Right, this here, just so here, and this is to signify that these are currency pairs that I'm currently focusing on right now. These are pairs that, opportunities are coming up to right now. So that is just it, guys. Let's move on. As a beginner trader, stick to one, maximum three currency pairs. Now, I'm going to be explaining, some few Forex languages to you. Now that you're in the Forex space, there are some languages you are going to, need to be hearing. I mean, there are some languages you're going to be hearing, and before you get to hear them, I'll need to, introduce them to you first of all. Right, let's move on. First on our list here is PEEP, and the full meaning of PEEP is just percentage in points. This is just the full meaning of PEEP, and it is the amount of change of the exchange rate for a currency pair. Right now, a PEEP is the fourth number after the decimal point in a currency pair, in the price of a currency pair. Right, this is it. Now, this is how you count your PEEP. This is 0.0. After the decimal point, it is 1, 2, 3, 4. Here is 1 PEEP. So this is it. The price of €1 USD is 1.0926 right now. So this is it. After this decimal point, you count 1, 2, 3, 4. If you have to add 1 PEEP to this price here, if you have to add 1 PEEP to this price, it will go like the price of this pair will be 1.0927. 1 PEEP added. If you have to take out 1 PEEP from this price here, it's going to be 1.0925. As simple as that, guys. Alright, this best explains it. Now, this is an example of what I'm saying. This is Euro USD, and this is the current price at which it is right now. If we are to add 2 pips to this price here, if we are to add 2 pips to this price, the price is going to be 1.2335. 2 pips added. Right. Moving on, this is the price of Euro USD, and it is at 10 points. If we are to add 10 pips to this price here, it is going to be 1.5731. Right, this is the price, 1.7 1.521, and if we are to add 10 pips, it is going to be 1.5731. As simple as that, guys. And this is it, guys. If I have to add 100 pip to this price here, 1.3572, it is going to be 1.3672, 100 pip, guys. So this will teach you how to calculate your pips, right? So pips on Japanese yen pairs, guys. Pip on Japanese yen pairs. Now Japanese yen pairs just move on to 2 decimal place. Now if you look at this Euro USD pair which I explained here, this one moves on to 4 decimal points, right? It moves in 4 decimal places, 1, 2, 3, 4, right? But pip on Japanese yen move only in, they only go up to 2 decimal points, right? So this is it. After the decimal point, you count 1, 2. This is the pip, right? So the real JPY pips on Japanese yen are essentially examples are GBP, JPY, Euro, JPY. Essentially pairs that are JPY in them, those are Japanese yen pairs. So this is how it is. This is how prices of Japanese yen pairs looks like. 1.70, 1705.55. So that is just it, guys. If you have to add 1 pip to this price here, it is going to be 107.56, 1 pip added. And if we have to take out 1 pip, it's going to be 107.54, guys. I get that makes sense to you. Let's move on. Now I want to explain bring to you the meaning of pipette, right? Now the meaning of pipette is this is 1/10 of a pip. Yes, this is 1/10 of a pip, and it's, let's just say it is just these are just micro pips, and it is the fifth number after the decimal point, right? And this is how you get to count after the decimal point here. You count 1, 2, 3, 4, 5. This is the pipette. This is the pip and this is the pipette, guys. So this is just it. Pipette. Sorry, guys. This is Euro US dollar, and the pipette here is this 5 here. And if this has to move 10 times before this will be added by 1, before the pip will be added by 1. So this is Euro JPY, Japanese yen pair. This is the pipette here. This is the pip. Moving on, let's go. Now I want to introduce lot size to you. Lot size is the size of your position. Now this is pretty much how many units you are buying or selling when you place a trade. This is more like, now trade forex is being traded in lots, right? Let's say it's the amount of position you are opening, right? It is the amount of unit of positions you are buying or selling in a given trade. And we have just we have just 3 types of lot size. One is a standard lot size, one is a mini lot size, one is the micro lot size, guys. So an example of this standard lot size is 1. Okay, now this standard lot size is also according to your account size, right? It's also your account size. If you're using I don't want to get you like, how do I explain this right now? I don't want to get your mind messed up with, right? But standard lots, let's say for instance, is 1 lot size. And if you're using 1 lot size to place a trade, guys, you are buying or selling 100,000 units. Okay, and if you buy 100,000 units, if the price goes up or goes down by 1 pip, you're either gaining $10 or you've lost $10. Guys, that is essentially how it works. If you buy 100,000 units, if it goes up or goes down by 1 pip, you gain $10 or you lose $10, guys. And the next on our list here is mini lot. And mini lot is 0.1. If you're opening a position with 0.1 lot size, yes, if if you're opening a position with 0.1 lot size, you are either buying or selling 10,000 units of that position, right? And if it goes up or goes down by 1 pip, you've gained $1 or lost $1 just by 1 pip. And the next one on our list here is micro lots. And the size of a micro lot is 0.01. This is essentially the smallest lot size a trader can use to open positions, in uh either in your broker or your MetaTrader 4, guys. So this, when you move on, you're going to familiarize yourself with these languages: broker, MetaTrader 4. So guys, don't overthink things, right? So this is the micro lot size, essentially the smallest lot size you can use to open a trade, and the size is 0.01 lots. And if you're using a 0.01 lot size, you are either buying or selling 1,000 units of that position, right? And if you are selling, and if the price of that position you open moves up by 1 pip or goes down by 1 pip, you've either gained 0.10 cents, or you've lost 0.10 cents when it moves by 1 pip, right? So guys, this stuff right here, I really need you to familiarize yourself with these terms, because you're going to be encountering them. These are languages you're going to be using now that you're in the Forex world, right? So when I say bullish, it means I'm expecting price to increase. Okay, when I say I'm bearish, I'm expecting price to go down. Now, if you are from the Forex, if you are from the crypto market, you might have very much heard this kind of language before: bullish, right? I'm expecting price to go up, I'm expecting price to go down. When I say long, it's still essentially it means buy. Okay, when I say, hey Emeka, please help me buy gold, or help me buy Euro USD, it means help me long Euro USD. When I say short, it is the opposite meaning of long. It is sell. Short means sell and long means buy. So stop loss. When I say stop loss is something I say it's a mechanism that is used to close positions at a preset price. Okay, with my definition here, it says it closes an open position at a preset price if it goes against you. Let's say you have an open position in your MetaTrader 4 or your broker. Stop loss is a mechanism at which your broker helps you take out your trade if it goes against you, right? So that is just it. Let's say I'm opening a trade. It's let's just say it's an algorithm that I'll just use to take out myself from a losing trade. I don't want to take more losses further than this. When price gets to this point, please take me out. That is what stop loss essentially means. And take profit is just the opposite meaning of it. It's a profit goal that closes the open positions if it goes as predicted. Now, let's say you have an open position. Now, this is a mechanism that you use to get away from the market. Once you have gotten to your you've gotten to where you want price to get to, you don't want to go any further, you don't want to take profit any further, your broker will just take you out, right? So guys, I guess with this little information in this course, you might have get yourself familiarized with the little knowledge and basic knowledge of forex trading, right? I want to say big congratulations to you, because this is a really, really massive one. Yes, you have dedicated your time to do this, and like I said in the video, you have to show up daily. You have to show up, you have to be consistent in this game, so you are going to win, right? So, guys, my name is Vince as usual, and I am going to see you guys in the next and upcoming course, right? Uh, Thank you for watching. Have a wonderful day, guys. I love you.